Hello, today is May 19th, 2021, and thank you for joining me for another edition of the Market Commentator Podcast. My name is Andy Wilms, and I'm the president and CEO of the Milwaukee Company. And joining me once again this morning is my son, Jake, who is a quantitative analyst with the Milwaukee Company. Today, Jake and I will be talking about the concerns many on Wall Street are having regarding the impact the additional government stimulus programs might have on the stock and bond markets going in the future, as well as inflation. We'll also be covering why Bitcoin and other cryptocurrencies have seen sharp declines recently. Before we get started, please keep in mind that this podcast is for informational purposes only and that the views expressed in today's podcast are Jake and my personal views and not those of the Milwaukee Company. And with that, I'll say good morning, Jake, and thank you for joining me.
Hey, thank you for having me on the show. Appreciate it as always.
Very glad to have you.
I wanted to begin, if I could, with talking about those potential threats to the U.S. stock and bond markets. As you know, the pandemic seems to be slowing down now. The economy is firing back up. Interest rates remain low by historic standards. But given that, why are we talking about threats to the stock and bonds if things are going great?
Well, the source of this concern stems from the fiscal and monetary policies that Congress and the Federal Reserve have been pursuing. As I'm sure all our listeners know, there's been a massive amount of money injected into the economy, and that increase has led to concerns about potentially higher inflation, rising interest rates, and what it might mean for the value of the dollar in the years to come. If we look at what's transpired recently over the past 12 months, the consumer price index jumped a little over 4% on a year to year basis, and with the price of goods rising by 7%. This has caused consumer expectations for rising prices to also jump to above 4%, and has also led to the yield on the 10-year Treasury note rising to above 1.6% as of this recording, which may not sound like much, but actually is a significant uptick from the 1% we were looking at the start of the year.
So, why might that be a problem?
Well, it's the risk is that as inflation expectations rise, they become embedded in consumer behavior and business decisions. Workers demand higher wages to keep up with prices. Businesses have to pay to keep those workers, and then prices rise. The businesses raise prices to compensate for their higher payrolls, and then workers demand higher wages to cover the new higher prices, and so on and so on.
Yeah, just a lot
And
about prices, huh?
yeah, well, and for those of us who remember back in the 70s and 80s, this can be a really difficult cycle to break.
So now, what do you think about Federal Chairman William Powell when he says to, never fear, it's just transitory?
Well, I will tell you that Federal Chairman William Powell is a lot smarter guy than I am. So I take what he says very seriously. He does point out that year over year increases seem high at this point because of a so-called base effect, which refers to the fact that inflation was so low, as a result of the pandemic last year at this time, that now the numbers are artificially higher because compared to such a low base. And Chairman Powell also would point out to you that the recent rise in prices being driven in part by constraints on the supply of goods and services brought up by restarting the economy. The whole COVID thing really disrupted the supply chain, and so until that supply chain gets running up and fully functioning, demand is going to exceed supply, and that's going to push prices up. And consumers are sitting on a bunch of pent up savings and government checks that they've collected, so there's a lot of money on the sidelines which can be spent.
So then, what side of the debate would you consider yourself on in this case?
Well, my personal view is that this is a serious concern, that investors need to factor into their thinking. I'm not in the prediction business, so, and I'm certainly not going to be able to tell you with a high degree of certainty what's going to happen in the months and years ahead. But I do think that there is a lot of good reason for concern. And so what I would suggest that investors do is take reasonable precautions to deal with the risk that we could see rising inflation and economic fallout that comes from that, and a stock market fallout that comes from that, without just taking overly drastic action.
What would you consider for listeners to do who share your concern and are agreeing with you?
Okay, well, if people are want to take some preventative measures, I think you have to look at it first on the bond side. One thing I will tell investors is, right, we all know that rising rates are generally speaking bad for bonds, right? Because as rates go up, the bonds that you currently hold have rates that are lower than what's being issued. So rising rates, there's an inverse relationship between interest rates and bonds. That's, I think we're all well aware of that. And so there's a temptation just to get out of bonds, but bonds are a very important a part of most investors' portfolio because of the stability they add. Not now, so I would not get out of bonds altogether. I think it's also important to keep in mind that not all bonds are as sensitive to rising rates as others. It really boils down to a measure called duration. The higher a bond's duration, the more sensitive, the harder rising rates are on the value of the bond. And duration, usually the biggest driver of duration is the maturity date of the bond. The longer the bond, the higher the duration. So what I'm getting to here is they might want to consider into investing in shorter term bonds rather than longer term bonds. And they might also want to consider looking at floating rate bonds and TIPS, which are floating rate bonds. We all know their interest rate just higher if the rate the bond pays goes up if interest rates go up, and with TIPS, the principal amount of the bond goes up if inflation goes up. So these bonds respond well in a rising rate environment, rising inflation environment, but they've gotten expensive as inflation and fears have grown. That said, that doesn't mean you should avoid them altogether at this point, because if it turns out that inflation proves to be greater than the market as a whole is assuming, then these bonds will still outperform other types of bonds. Another important thing I guess I'd mention, Jake, is, you know all about this because we were working on this here in our office. We started doing this a year ago, but they might want to start looking at rotating out of longer duration, longer term bond ETFs that are most. Let me back up and say most bond ETFs are considered perpetual bond funds, and that when I say that, I'm talking about the fact that they don't hold bonds to maturity. They keep turning those bonds over to target a certain duration. So if they want to target a duration, let's say 10, or a term period of 10, then they will sell bonds that get below that point and buy new ones. So the bond fund the bond fund doesn't have a maturity date. As a result, as interest rates go up, the price of the shares of that ETF will go down, all things being equal. And so, especially if the ETF is targeting longer term bonds. So, as an alternative, you could look to either going into bond ETFs that target a shorter maturity date bonds, or there's a vehicle called a defined maturity date bond, where a bond ETF, where all the bonds in the ETF mature on the same day, and everybody who's invested gets their money back. The fund closes and people get their money back. So they, like a bond, they do have a maturity date. And so even though the price may fluctuate, so long as the bonds in the fund don't, default, the investor knows if I hold on to this, and just like with an individual bond, if I hold on to this to the maturity date, I'll get exactly what I was expecting to get when I invested in it. And so rising interest rates or inflation aren't quite as harmful to those type of bond ETFs. And then the last thing I might point out is for those who want to hold cash or cash equivalents, it's best to do so in investments that have floating rates like money market funds, as compared to those type of investments that would have a fixed rate, such as a CD.
Should investors worry about their equity exposures as well?
Well, again, it all boils down to time horizon, investment, and risk objectives. Investors who have a longer time horizon and can tolerate volatility up and down maybe all just fine sitting tight, because generally speaking, the stock market can tolerate inflation so long as it's gradual and does not spin out of control. But investors who are less tolerant of volatility or have a shorter investment horizon might want to make some tweaks to their equity portions of their portfolio too. And one would be perhaps to rotate out of growth stocks, which tend to do worse in a rising interest rate environment, and rotate into more value orientated stocks. Another would be to perhaps stay away, or not stay away, but lower allocations to dividend stocks that can struggle if inflation rises, because the purchasing power of the dividends they pay will be eroded. And a final one might be to consider lowering your allocation to small cap stocks, especially small cap growth stocks, because they are more sensitive to higher interest rates than larger, well-established companies, because they tend to borrow more money.
All right. I think that answers all my questions about those.
All right, well then let's switch gear a little bit and talk about a subject that I'd like to pick your brain on, and that is cryptocurrencies. We've seen a lot of volatility in the cryptocurrency market as of late. Bitcoin is down. I think it's around 30+% since mid-April. And other popular alternatives, things like Ethereum and Dogecoin, they've also seen sharp declines. So what's going on here?
Yeah, cryptocurrency is in a weird time right now. In the last couple days, it's been pretty much a pitfall on their valuations. Investors are selling off, and I know a lot of people may have some questions, so I'll try and clear up my best I can for what I think is going on. The big thing that's driving this, at least as of today, with the sharp declines that we're looking at right now, is because China came out and banned financial payment with cryptocurrency. And this is a pretty substantial change because it is China saying that they do not believe in cryptocurrency's valuation and it's too turbulent for their citizens, and they're going to be not allowing people to use it. And I think this is pretty important to be considered because China may not be the only country that deems this. And as a result, the valuations are going down across the board, not just for Bitcoin, but for all the cryptos.
I'll just point out quickly, Jake, that might be what the press release that China is, officially giving. But I think it's much more about maintaining their authoritarian grip on the currency. They want to control their economies, and they can't do that nearly as well with something like cryptocurrency takes hold, because they can't control cryptocurrency. They can't control the yen.
Right. Exactly. And this is just one piece. The crypto market has been struggling as of late before this announcement today. And in my view, what I think the biggest thing that's going on is people are identifying the environmental factors of mining cryptocurrencies and the carbon footprint that the industry has. And it's as a result weaning consumer confidence in crypto as an investment. Elon Musk made headlines by announcing that Tesla was going to suspend Bitcoin as a payment method. due to specifically the environmental impact of fossil fuels are being had when mining for Bitcoin. And this sent it tumbling, and as a result, Ethereum and Dogecoin and other popular cryptos are going to be positively correlated, so they're going to follow with it as well.
Well, it's very interesting because Elon Musk made his name, as trying to help the environment, right? That was the whole idea behind Tesla, and yet here he was, the guy, one of the biggest proponents of cryptocurrency. You would think he would have been well aware of the environmental impact crypto has before he started backing it, and yet now he's turned around, made another 180-degree turn, and seems to be running away from it. So
Yeah,
it'll
I
be
think
interesting. Go
it
ahead.
caught a lot of people off surprise. You wouldn't necessarily assume that a cryptocurrency would be associated with fossil fuels, but when you follow the breadcrumbs, it makes a lot of sense. When cryptocurrencies are increasing rapidly in valuation, the interest and demand for obtaining it or mining it goes up. And if you recall from a previous podcast, when I talked about how cryptocurrencies are mined, powerful computers are going to be solving complex equations in order to earn these coins. And they are at a fixed number for the most part, in Bitcoin's case. So there's only a scarce number available, which further drives up the demand. And as a result, all of this demand is going to be pushing for more mining, and that's going to be using a lot of electricity. And that electricity consumption increase is going to be pushing that fossil fuel consumption up as well, which is bad for the environment. And when I talk about this mining, I'm not thinking about your average person who may be mining a little bit on the side or have one, two, even three mining rigs at their home. It's these mining centers, as they're called. These are large scale operations for mining cryptocurrency, and they're usually done in repurposed power plants or similar venues that have access to large power, large amounts of electricity.
Yeah, the supercomputers they use must really suck up a lot of electricity.
Yeah, they use what they really do is they have hundreds or thousands of graphics cards, and they have them all lined up in a big giant rig, and they're all pushing for the mining all at once, and it's a huge amount of electricity. But again, the levying the economies of scale is efficient, so people tend to do it. I mean, if you look at one plant in New York alone, they were mining 5.5 bitcoins a day in 2020.
Wow. Well, I know that you and Michael have had trouble getting graphic cards for your computers
Yeah,
for gaming
that's
because I've heard you complain about those damn miners. But I guess we'll have to just see how this all plays out. But one thing, one thing I would say is, the volatility that you were seeing with cryptocurrency makes it very hard for it to truly become a currency because, it's very difficult to use currency to buy something when the value of the currency you're using changes, by many percentage points a day. You really don't know what you're paying for something if the value of the currency you use to buy it is changing. So I
right. I
think
totally agree.
that's another big threat to the whole crypto craze. I'm not saying that I think crypto has had it or done for, but I think there are safer ways for people who are interested in investing in, getting away from the traditional currencies as an investment because they're worried about what's happening with the actions of the Congress and the Fed, printing so many dollars that could ultimately undermine the value of the dollar. Some have suggested it might and eventually mean that the dollar will no longer be the world's reserve currency. And so if that happens, that could be a really big problem for the U.S. Nobody's thinking that's going to happen right away. But I think we see the surge in gold correspond to the fall in crypto because gold is an alternative to crypto for those looking for that type of alternative to the dollar and other world currencies.
Yeah, I totally agree with you. But I think it's important to understand that most investors are not purchasing Bitcoin to use it as a currency. They're
Right.
investing in it like a stock or an ETF, and they're trying to identify intrinsic value in it that it will appreciate over time and earn a return. Now,
Right.
what's different about Bitcoin and other cryptocurrencies to something like Apple or Tesla is that they don't have a business to rely on that can perpetuate the value of the security. It doesn't have
Exactly.
something to rely on to say, hey, Tesla really is worth this amount and it's really
It has
unlikely that it'll go
assets, it
down.
has an income
Yeah,
stream it generates, so it can only go so low. You know what
right.
I
But
mean?
Bitcoin, it could go, I mean, all the way to zero if theoretically, not that it would, but I mean, there really is nothing stopping it. It's really a unique way to invest. That's for sure. And it's subject to a lot of regulation and oversight, perhaps in the future. We're looking at what China's done. And that isn't even the only way that governments across the world could regulate away cryptocurrency's use. I mean, we're looking at
Right.
New York in the US. They're looking at prohibiting the use of mining centers and really mining in general in the state until they can understand the environmental impacts. And if that bill is to pass, then you're not allowed to mine cryptocurrency in New York for 3 years.
Wow. I guess that would be pretty detrimental to the
Yeah.
whole
And so there's a
value.
lot of questions, I think, for
Or maybe it
sure.
would be positive because people couldn't mine it, so that then the supply would be further constrained. I mean, it's very difficult to predict with any kind
Right.
of confidence where this all comes out. But you know, a lot of people have made a lot of money in it so far, so I guess I can't be too critical. I prefer to invest in things I understand and know. And since this whole cryptocurrency thing, um, I don't fully grasp where this is going. I have a hard time in my mind visualizing it. It may not be the right investment for me, but that doesn't mean, Jake, it isn't the right investment for you.
Right.
So,
Yeah, I wouldn't say that, my takeaway is that even though there's looming regulatory changes and there's a lot of downward pressure on the valuations as a result of like this massive sell-off, I don't necessarily believe that these are overvalued in a long-term sense, but I would say that their sensitivity is a valid concern and it does point to their valuations being too high at this time because if they're so sensitive to news and regulatory changes like this, and to the degree that we're seeing, that would suggest that they're overvalued because stable securities wouldn't be fluctuating to that degree.
right.
But it is impossible to say what's going to happen, as you pointed out. But I wouldn't rule it out completely either. So it's an interesting thing to be keeping your eyes on.
It's just another example of buyer beware, I
Yeah,
guess I would say.
100%.
Okay. Well, let's wrap it up there, Jake. I'd love to keep talking about crypto with you. Maybe we can do that over lunch, but
That
unfortunately,
sounds
our
great.
podcast has to come to an end. So I want to thank you for joining us and our listeners for listening in. And I'd also like to remind our listeners that they should conduct independent research before acting on any information or opinions expressed during this podcast, that they should not act on anything they have heard in the podcast until they have discussed it with a qualified financial professional who is familiar with their personal situation and investment objectives. And with that, Jake, I'll wish you and our listeners a great day.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.